can start working on the page while we're waiting. We have a minute left, so start working on the page. Try to get ahead of me. Huh? You don't have to wait for me. Okay. Let me give you a sense of what this is. Remember that I told you last session that there would be a post, I might not have mentioned, but there's a post-class test you can take after the session ends to see what we talked about. So I'll post that. But in this class, there's also going to be a start of the class test, which is going to look just like this for every single class. And it's going to be a little backwards. What I'm actually going to do is take, in most classes, take what we're going to do in that class over the next 80 minutes and ask you questions about what we'll do in the next 80 minutes. That's why it's backwards. And here's my rationale. Most of these classes, you're going to notice that using common sense and the financial tools you already have, you can pretty much get to the answer. So first, I want you to recognize there's nothing here that we do that is earth-shattering, something revolutionary. I want you to see that you could have got to the same answer without coming through this class. There will be cases where your intuition will lead you down the wrong path, and hopefully those will be useful exercises to see why it happens. Okay? Today's start of the class test, though, is a little different because we're going to go back and talk a little bit about what we ended the last class with, which was the notion of bias and how it affects valuation. And we also talked about uncertainty and how it throws off valuation. So let's revisit the question of bias. I said everybody who does valuation brings some bias into the process. The question is how much bias and which direction. So I'm going to present you with a dozen different scenarios. And here's what I'd like you to think about. With each scenario, tell me which direction the bias is. Are you going to be biased to come up with a higher value or a lower value? And then tell me what mechanism in the valuation or in what you're doing you'll use to kind of deliver that bias. Right? So let's start with the first one. You own your own business. You're valuing your business for sale to a third party. What's your going to be? To bias up, bias down, Yogesh? So what are the mechanisms you're going to use to push your number up? What are some of the ways you're going to do it?
Maybe growth, market values, customers.
First is you're going to claim to have a big business model rather than a small business model, right? You want a big potential market. Then when you show me your growth rates, you're going to show me all these great growth rates in the future. What about margins? You're going to show me your margins improving over time. If I ask you, is there any chance your business will fail, you're going to tell me?
No.
Absolutely none. When I ask you about competition, you're going to tell me, there's none. Nobody can match what I do. But that's, you can see why that is, right? You want to push the value up. Let's take the second scenario. Everybody agree with that? You're valuing your own business, or you want to get a high number. Now you're a venture capitalist valuing the same business. You know how this works, right? I supply capital to you. In return, what do I get as a venture capitalist? A share of the ownership of the business. So whatever value I assign will determine how much of that. So what's the bias going to be here? If I'm the venture capitalist valuing your business, what am I going to claim your business is worth? It's worth nothing. Give me everything. How do I make my valuation, or push the valuations down? How do venture capitalists value businesses? Very badly. Let's start with that. But it's a very, very simplistic way they do it. They project the earnings out 3 or 4 years from now from your business. They apply a multiple to that based upon what they think they can take your business public or sell to somebody else. And then they discount it back at what they call a target rate of return that they come up with. So help me out here. If I want to look value for your business, what's the first thing I'm going to do in terms of earnings? I'm going to claim your earnings in 3 or 4 years is going to be a pretty small number. I'm going to apply as low a multiple to that as I can because I want to come up with a low value in 3 or 4 years. And then when I discount that number, what kind of target rates of return are you going to see me use? Really high. And if you look at venture capitalists, it's outlandishly high, 50, 55, 60%. We know they're lying when they say this is what I require on my investment. You know why? The actual returns that venture capital deliver is closer to 15% than it is to 60%. They actually don't do that much better than the S&P 500. But they say, we want to make 60%. But it's a way of, it's a negotiating ploy. It brings the number down. And then they also play this what's called pre-money, post-money dance. Does anybody know the difference between pre-money and post-money? What the heck is that? What does that even mean? Ben?
Money is a valuation before they give you whatever capital they want to invest in the company.
So why? So the difference between the what will then be the difference between the two numbers?
Just their invested capital.
At all, though? What else am I going to claim? I'm going to claim that if you don't get the money I supply you, then when you go out and run this business, you're not going to be able to grow as fast. So it's actually a little more messy than just adding the cash on. And we're going to talk about this when we talk about private businesses, because I'm going to argue as a venture capitalist, if I'm not around, you're never going to be able to raise this capital. If I'm not going to give you the capital, you're going to stay small, your growth rates are going to be small, your margins are going to be smaller, much. So the pre-money, post-money becomes a negotiating ploy to push the value down so I can get a bigger share of that value. Okay. Third scenario. Business estimated value will go to your soon-to-be ex-spouse. So tell me, bias up, bias down? Yeah, you're going to claim, my business is worth nothing. Half of nothing is nothing, so take nothing. Right? We're going to do company appraisals. Is my sound going in and out? No. We're going to talk about private company appraisals through maybe volume. This class, one of the things we're going to talk about is how so many private company valuations are done for one of two forums. One is divorce court, the other is tax court. So you're valuing a business, so half of it goes to your spouse. You're valuing a business, so 40% goes to the IRS. And guess what? In both cases, you want to come in with as low a number as possible. So what's the mechanism that you're going to use for this? First, you're going to come up with low and high discount rate, claim risky business, come up with a low number. And after you're done with that, you're going to do a heck of a lot of discounting. You know what I'm talking about? You're going to apply an illiquidity discount, controlled discount. Basically, you just do discounting until you run out of words. Private company discount. You become rich for it now and essentially push the value down. You're in a You're going to come up with a value, again, using many of the same mechanisms that we used before. You're an appraiser for the IRS, looking at the same business. What's your bias going to be? You want to be a high bias. In fact, a few years ago, I had to give a talk at one of these conferences about, I don't know how I ended up, it was a tax conference, and half the people there were from the tax side of the picture. They work for the state tax department, the IRS, you know. The other half were appraisers who work for the business side. So I asked a question. It was about equity risk premiums, which is a big input into the value. So I said, before we even start talking about equity risk premiums, how many of you use equity risk premiums higher than 6%? And one half of the room all put their hands up. And then how many use equity risk premiums less than 5%? The other half of them put their hands up. Who use the high equity risk premiums? What happens when you use high equity premium? Your discount rate goes up, your value goes down. So all the people who are appraising businesses for the tax guy were saying, hey, we use really high equity risk premiums because we want low numbers. Again, this is going to come up when we talk about equity risk premiums because people come in with agendas. Pick and choose the number that best fits that agenda. You want a low value, you're going to come up with the approach that gives you the highest equity risk premium. You want a high value, you're going to come up with a way of the lowest equity risk premium so you can push up the value. Okay. You're a sell-side equity research analyst valuing a company with the intent of putting a buy or a sell recommendation on it. Bias up, bias down, bias. It's a tough one, right? Depends on who your clients are, right? So if you view your job as giving independent, true research, and you say, I should have no bias, I'm going to call it as it is. But there is a problem with the way equity research is structured, right? So if you're a sell-side equity research analyst, what does the rest of it look like? Very depressing. Hey, here's what it looks like. You're given a sector. And you're told, follow these 15 companies for the rest of eternity. So your job then becomes not burning any bridges. They're your only source of rumors. Of course, they can't feed you any real information because the SEC says they can't do that, but they might give you hints. So you want to maintain good relations, right? So whether you like it or not, it's going to feed into recommendations. So how many, if you look at buy and sell recommendations, you know what the ratio of buy to sell recommendations is still? No, at the peak 15 years ago when you had those scandals, it was 15 to 1. 15 buys for every sell. It still runs at 7 to 8 buys for every sell. A lot more buy recommendations than sell recommendations. You're an M&A analyst working for the investment banker for the acquirer in a friendly takeover valuing the target company. Bias up, bias down, no bias. Think through your self-interest, right? Takeover to go through? Yeah, the investment bank. Of course you want the takeover to go through. And to make the takeover go through, what do you have to show the board and your stockholders as the acquiring company that you're getting a bargain, right? And how do you show you're getting a bargain? You take whatever price is being paid. So if it's Liberty Global, you tell them, hey, you know what, Virgin Media is really worth $25 billion. We're getting it for $16 billion. So the bias is going to be to push it up because you want a high value because in a sense you want to be able to justify the price being paid. What if you're the investment banker in a target company? Now what do you have? What's your job? It's convince the target company stockholders that they're also getting a good deal, which means you want to show them also that the value of the company is higher than the price. One of the few cases. This is why I said friendly mergers are marriages made in hell. Because you get the 4 guys in the room, they're all going to agree on everything. Because as you can see, everybody's pushing the deal. Let's look at hostile mergers. You're an analyst working for the investment bank, they acquire a hostile takeover valuing the target company. You have to show that the value that you're getting is that you are in fact still getting the deal. So your value has to be higher than the price. You still have to convince your stockholders. But if you're the investment banker for the target company, what do you have to show them? You still have to show them that they're, if this is a hostile takeover, now you're confused, right? You're saying, what do I do now? You're the investment banker for the target for hostile takeover. You want to stop the deal, right? That's why you were hired. And how do you stop the deal? By showing the price that's paid is not high enough. So you're going to come up with a value, but it's going to be even higher than the value that it's an elaborate game that you're playing here. You want to make sure that you convince your stockholders not to tender on this deal because you're not being paid enough. Again, both sides are pushing in the same direction, but the numbers that they come up with can be very different because they're selling to different audiences. Let's talk about your valuing a company for your portfolio manager who happens to own 1 million shares of the stock. I think there's any bias in this process. It was just at Fidelity last week. They hire analysts. Their job is to assess the value of companies fairly. Portfolio manager says, go value that company for me. Oh, by the way, I own 1 million shares of the stock within the company. You think he might have tilted the scales a little bit here? Because if you come back to him and say, you know what, you shouldn't be owning those shares, they're overpriced, he might say, congratulations, this is exactly why I hired you, to give me independent advice. Or he's going to say, well, I think your numbers are wrong, go back and redo it and come back to me when you come up with an answer that I like. Bias, again, can get created based on what you already own. In this case, this is going to be to value the, because your managers want that answer. They want to say, oh, it's okay, let me continue to hold this company. And by valuing a company for your portfolio manager happens to have shorted 1 million shares of the stock, it's the opposite. He wants you to tell him, hey, this is the most overpriced stock, so your bias then is going to be low. So here's what I'd like you to try and do. Right? There are dozens of valuations you can pull off online, equity research reports, acquisition valuations. Just pull a few off. Then ask yourself, can you first determine, based on who's doing the valuation and was biases, but here's the trickier part. See if you can find how they slipped the bias into the valuation. Was it through the growth rates? Was it through the discount rate? Right now, you might not have the tools to do that, but part of what I'm going to try to do in this class is give you a way where you can go to valuation and bias detector. In fact, I have this vision of actually writing a macro that'll actually go through Excel spreadsheets. Say, found bias, 17 biases, here they are, right? Think of, I mean, I could make an immense amount of money if I wanted to, selling it to lawyers, because they could be bias detectors and sue you for everything you've done. But I'm not going to do that. I don't like, but you will have the tools to be able to do it if you want to make that your business. So keep that on the table as something that you'd like to do. So I talked about a hostile takeover, how an M&A, if you're an investment banker in a hostile takeover, you have to convince your stockholders that it's a good deal. You simultaneously convince the target company stockholders that they're getting a good deal too. I don't know how you pull this off. I mean, because there's only one price. So you're able to tell your stockholders at that price we're getting a good deal, but then you turn to the target company stockholders and you tell them at the same price that they're getting a good deal, right? I don't know how you pull this off, but people try all the time in hostile takeovers. In fact, they might have two different investment banks which have different values. One for the acquiring company, one for the target company stockholders, both paid for by the acquirer's money. Let's set this aside and move back to the first packet. Okay? I'm sorry, not the first packet, the intro. We were on page 4, I think, so let's go back to that page. So I talked about, yes, go ahead.
Given the illustrated with the bias, for equity research reports, how much evidence is there that people follow the average investor, institutional investors?
Yeah, we'll come back to that because it's not that, I mean, did everybody get the question? Which is, know that equity research analysts are biased, that the buys are really outlandishly high relative to the sells. But remember that equity research analysts are masters at saying sell without ever using that word, right? And what are some of the mechanisms they use? It goes from a strong buy to a semi-strong buy, a semi-strong buy to a weak buy, without ever saying the word sell. So you can actually do quality equity research, send me the signals in subtle ways. Okay? And that's why there are some of these equity research houses have numbering schemes. 1 through 7. That way you don't have to use the word say. You can lower you from 1 to a 2. The very best to the second best, but hey, take the message. Go sell the stock right now. So you can still equity research the buy and the sell. Okay? So there are effects. I mean, I think that their effect is exaggerated. They don't have as much an impact as most people think they do, but I think it is true that they do have an impact. At least in the short term, they can create momentum. They can cause prices to just at least over short periods. They can't change the underlying reality. That is, I think, something that they cannot do, but they can make the short-term dynamics kind of work away from you. Let's talk about Bermuda Triangle of valuation. Remember, that's the way I ended the class here. I said, valuation, this is where valuations go to die. They go into the Bermuda Triangle. We talked about two sides of the Bermuda Triangle. One is bias. The other is uncertainty. Bias, the problem is you come into conceptions. The uncertainty, the problem is it very, very unhealthy ways as human beings to uncertainty. I'll give you the analogy I offer when I talk about uncertainty. Let's say you were driving down this deserted highway Your GPS has, you've lost signal. You have T-Mobile. Your signal was gone a long time ago. So your phone just says, you're back in New York still, and you're 200 miles away. You come to this fork in the road, and you're with your spouse in the car. You have no idea which side to go. You're facing tremendous uncertainty, right? So what are some of the things you might do? One is paralysis. You know what form this takes? You stop the car and say, until the uncertainty resolves itself, let's just stay here. In which case, you're going to be stuck in that car forever. The second is you take the right fork. Why? Because the last time you got lost, you took the right fork, it took you to the right place, so you're saying, well, it always seems to work. That's called mental accounting. You've created a rule with no basis in reality. You do it because that's what you've always done. Daniel Kahneman has an entire book on how mental accounting drives us. I mean, we think we are reasoning our way to an answer when in fact we have no basis for that answer. The third is you turn to your spouse and ask, which road should we take? That's outsourcing. Basically, you blame somebody else then. It's exactly what you do when you're faced with uncertainty in valuation. There's paralysis. There's too much uncertainty, so I'm not going to do a valuation. So what are you going to do instead? I'll look at the chart, or I'll do a price to sales ratio. There's no uncertainty there. It is mental accounting. Whenever I feel uncertain, I use a 20% revenue growth. Okay, that came out of nowhere, but we'll do that anyway. And the third is outsourcing. When you're uncertain, what do? You ask somebody else. An expert. You pay him a lot of money and you say, why don't you tell me what the growth rate is? We outsource. We ask managers, we ask analysts, we ask experts. All very unhealthy ways of dealing with uncertainty, but it kind of gets in the way of valuation. Which brings me to the third side of the triangle, which is complexity. We live in a complex world with a lot of complex data and a lot of complex models. Let's face it. The world you and I go into value companies is very different than the world Ben Graham went to in the 1950s, right? In the 1950s, you probably had 1,000 publicly traded U.S. stocks, not that much outside the U.S. If you wanted a filing from the SEC, you know what you had to do? You had to go to the SEC building, you had to sign in, go look at the physical filing. Data was limited, models were limited, the world was... And everything's become more complex. And it's so easy to build big models now, right? And God help you if there's a team in the basement whose job it is to build models for you. You know what I'm talking about? This is Geek City. You hire 15 quant people and you send them down in the basement. Build models. They love building models. They put macros on top of macros. Inputs come in, they never leave. So you start off with 15 inputs to value companies. 20, 25, 30, 40, 50, 80. Finally, they finish the model. It's a beautiful, elegant model. Lots of inputs, great things happening inside. Then they send it up to your desk saying, from this day on, when you value companies, use our in-house model. Two things happen to these models. One is what I call input fatigue. You know what input fatigue is? I'll describe it to you. And if you ever worked in investment banking or in any job that requires you to give up your weekends for the rest of your life, you'll see exactly what I'm talking about. It'll hit you around 11:30 on a Saturday night. And this is what's just happened. You thought you were done for the week. You were getting ready to turn off your laptop, computer, desktop, whatever. When your managing director comes in and throws a 10K on your desk. I want this company valued on my desk first thing tomorrow morning. It's Sunday morning. This is his trial by fire. He wants to see how much you really want this job. Part of you wants to exercise your option to abandon. Describe the option, but it's deeply satisfying when you exercise it, but there are lots of unsatisfying moments thereafter. It usually takes the form of 10K flying back into your managing director's face saying, you do it yourself. That's a deeply satisfying moment as it leaves your hand. And then after it leaves, everything after that is just very unsatisfying. You know, your job's gone, your rent has to be paid by somebody else, you're homeless on the streets, whatever. So you think about the option to abandon, but you restrain yourself. You remember the rent payment, the car payment. You get ready to value the company with the in-house valuation model that was sent up this morning by the geeks down in the basement. So you sit down, you start entering the numbers. You get to the 10th or 11th input, the clock strikes midnight. You're not Cinderella. You wish you were. Then you look down there, 74 more inputs to go. Your stomach drops. You look at the 12th input. It says, what was the inventory 5 years ago? Part of you wants to go look up that number, but that part's too exhausted to get out of the chair. The other part prompts you. And let's move on. And it's amazing how the random numbers all roll out, right? The scary thing is when the output comes out, it all looks the same. That number you toiled hours over, random numbers all swim together. And here's another little secret in valuation. If you want to hide your random number inputs, create more detail in your output. Have 35 pages and 500 line items. Nobody will have any idea what's random and what's not. And let that be an indicator. If you're on the other side of a table and somebody presents you with a valuation and runs 35 pages and 500 line items, the question you should always ask is, what are you trying to hide from me? There's a message I want to deliver. Good valuation should be parsimonious. Less is more. Fewer line items are better than more line items. Never add more detail than you absolutely have to. So anytime you feel this urge to break things down, ask yourself, am I adding anything to this valuation by breaking this down, or am I just trying to intimidate somebody by having more line items in my valuation? So that's input fatigue. Second is the model becomes a black box, right? So complex, you have no idea what it does. I remember a conversation I had with a sell-side equity research analyst at JP Morgan. This was about 20 years ago. On a buy recommendation he had in the stock, and he had a price of 85. The stock was at 35. So I asked him, what do you think, what is it about this company that makes you like it so much? Why do you think it's worth 85? And he said, I didn't do it. So what do you mean you didn't do it? Your name's on the report, it says $85. He said, I didn't do it. So I said, who did? He said, ValueMac did it. I said, who the heck is ValueMac? He said, that's our in-house valuation model. I said, what did he do? Sneak into your office in the middle of the night, value the company, and leave it on your desk? But you know what he was trying to tell me, right? He said, look, I fed the numbers into this really complicated model. I have no idea what happened in there. $85 popped out on the other side. I didn't value the company. The model valued the company. If you ever see those words in a report, step back, because the analyst is saying, it's not my fault. I work for the model. The model asks me for numbers, I feed it the numbers. It asks me to go get a cup of coffee, I come back, it's left the number on my desk. It's really not my fault. As you go through the valuations of your companies, on my, you can pull any of the spreadsheets of my website to use your valuation on one condition. I don't want to see the following words in your final report. You know what those are? The Damodaran model value the company at. If I see those, it's an immediate F. If you take the spreadsheet, make it yours. If you don't understand what's going on within the spreadsheet, build your own. Never ever use valuation model where you have black boxes, we have no idea what's going on. In fact, returning to the principle of parsimony, and here's a follow-up. You can angle some really simple assets using complex models. What's the simplest asset on a company's balance sheet to value? Of all the assets you see listed on the balance sheet, what should be the simplest one? Cash, right? You might not believe this, but every week I get at least a half a dozen emails from people claiming to have built a better model to value cash. Most of these are people I don't know. Right? So this is how it'll go. Professor Deodorant. It's amazing what Microsoft, that's exactly what Microsoft Word spell checks my name to. It says, you sure it's deodorant? Deodorant sounds a lot better. Hey, at least I smell good. It could be a lot worse, right? I've spent the last 6 months of my life building this model to value cash, which my first reaction is, what an empty life you must have. And after this elaborate build-up, they say, could you please take a look at the attached Excel spreadsheet that I've built to make sure I've done the right thing? I actually don't even open the spreadsheet. I'm not opening a spreadsheet from somebody I don't know. Who knows what viruses lurk in there? But I programmed the F7 key on my laptop to respond to it. I hit it. You know what it says? Have you tried counting the cash? It works. 20, 40, 60, 80. You don't need a model to value cash, because here's what happens. You build a model to value cash. Let's take a company with a lot of cash. We could take Apple, but let's skip Apple. We talk about Apple so much. Let's say Google. It's got 60 billion in cash. When you see cash of that magnitude on the balance sheet of a U.S. company, where is that cash usually invested? but where even it's not it's abroad in the sense of it hasn't taken a flight. It's abroad, but then it comes back. It's actually invested in T-bills, commercial paper. So even if it's trapped overseas, and the Wall Street Journal actually had an article on this 2 weeks ago, it's often invested in short-term, liquid, close to riskless investments. Let's not even, right? So right now, if you invested in short-term, liquid, close to riskless investments, what's that 60 making? If you're lucky, maybe a 0.5%, maybe, let's round it up, 1%. So you got 60 billion in cash earning 1%, right? So you project the income on the cash. This is what happens when you build models. So now you have the income from the cash. And once you project the income, all is lost. Because then the Pavlovian response kicks in. You know what I'm talking about? This is what you go to business school to acquire. You project numbers out. What are you trained to do? Discount them. To discount them, what do you need? A discount rate. So you pull up your corporate finance book, your valuation book, you put in betas, cost of equity, cost of capital. You come back with a 10% cost of capital. You're ready to chug. 60 billion in cash, invested risklessly, earning 1% a year. Project the income. Now discounting that income back at a 10% cost of capital. What's the 60 billion going to be worth? It's going to be worth 50 billion. You just wiped out 10 billion. You didn't realize it was that easy to wipe out 10 billion, right? Because you took a riskless income stream and discounted it back at a risk-adjusted discount rate. You think, what a dummy. I would never do something like this. If you ever estimate cash flow starting with net income, you know what you've just done, right? What goes into net income? Net income from the operating assets plus net income from cash. You're discounting cash flows based on net income. You've done exactly what I described. You did it implicitly rather than explicitly. So here's the rule we're going to follow. With every company, every asset, the question I'm always going to ask is, what's the simplest way I can value this asset? If I can value it with 3 inputs, I'm not going to go look for 5. If I can value a company with 3 years of projections, I'm not going to do 10. You're saying, what's the harm? The harm is I have to estimate those numbers, exposing myself to uncertainty, estimation risk that I don't have to. So that's one of the challenges of this class, is finding the most parsimonious way to value an asset and using it, rather than always using the same approach to value every single asset. Let's set the table. There are 3 basic approaches you can use for valuation. And we're going to at least lay out the difference of the approaches to that. This is intrinsic valuation. In intrinsic valuation, you value an asset based on its cash flows, its growth, its risk. The tool that gets used most often for intrinsic valuation is discounted cash flow valuation. What I'm trying to emphasize is the two are not interchangeable. All discounted cash flow valuations are trying to do intrinsic valuations, but not all intrinsic valuations are discounted cash flow valuation. There might be other ways in which you can estimate intrinsic value. But you're valuing an asset based on its own characteristics. In relative valuation, you value an asset based on how similar assets are priced out there. Essentially, your pricing. And the third approach is contingent. Essentially, you have assets whose cash flows are contingent on something happening. You value those assets using option pricing. So here's what I'd like to do. I'd at least like to describe each of these approaches and then talk about what you might need for that approach to work for you. But before I do that, let me set what should be an accepted wisdom, but often is not, right on the table. Implicit in using all of these approaches as an investor to value stocks is the assumption that markets make mistakes, right? Because if you believe that markets never make mistakes, this class wouldn't last a few. Because if you ask me, what's the value of IBM, you know what I'm going to ask you to do? Open the paper, look it up. Or get online, look it up, you're done. In an efficient market, there's really no point to doing valuation except to affirm that the market price is right. So with each of these approaches, here's what I'm going to present. You have to make an assumption about how markets make mistakes. It's going to be different approaches, and how markets correct those mistakes. Both pieces have to come in for you to make. So let's take discounted cash flow valuation and spend a little time on what it is and why you might want to use it or why you might not want to use it. So just looking at the big picture here. In discounted cash flow valuation, The value of an asset is the present value of the expected cash flows on that asset. Does that sound familiar? I hope it does. Because it's that very first finance class you ever get, right? The value of an asset is the present value, and then you use a bond, and then you kind of climb up the risk ladder. But it's that same equation kind of fleshed out. And in discounted cash flow valuation, here's what you're trying to do. You're trying to estimate the intrinsic value of an asset. I've had long debates with equity research analysts who contend that there's no such thing as intrinsic value. That this is only something that we dance with as. I am firmly convinced that every asset has an intrinsic value. I also am firmly convinced that none of us will ever get to see it. Which means discounted cash flow valuation is a little bit like the search for the Holy Grail. You know you'll never get there, but the fun is in the looking. So don't expect affirmation in this process. You do a valuation. You ask me, is it right? I have no idea. You are trying to estimate intrinsic value. And if you break down a discounted cash flow valuation model, no matter how complex it is, there's three ingredients. There's a life for the asset you value. So if it's a rental building, you might say it's 15 years. If it's a business, it might be 20, 30, even forever. The cash flows over that life, not right. Let's not make it more complicated than it has to be. Those are the ingredients, the three ingredients that drive a discounted cash flow model. But let's cut to the chase. I don't know about you, and I said this in the first class. I don't value companies because I'm intellectually curious. I don't lie awake at night wondering, what's Apple worth right now? How about right now? I don't care. Maybe you do. But I value companies for one reason and one reason alone, which is I'd like to make some money off my valuation. Very pragmatic. That's why I said valuation is not theoretical, it's pragmatic. So let's see the pieces that have to come into play for you to make money on discounted cash flow valuations. First, you have to assume that markets make mistakes, right? Is that an easy assumption to make? Absolutely. I don't think you'll find a single person in the world who will disagree with you. Of course markets make mistakes. Second, you have to assume you can find those mistakes with your metrics and models. Now we're on dangerous ground. You know why? What's the track record of people who claim to find market mistakes? It's not that good. In fact, remind me again what the average active portfolio manager beats the S&P 500 by each year. That's a trick question. The average active portfolio manager delivers 1.5% less. And it's not just the S&P 500. S&P actually does this across the globe. They take Indian portfolio managers against the Indian. So basically, you could be value investors against a value. You pick any slice of active portfolio management, you deliver about 1 to 1.5% less than the index. It's the strangest profession. Because think of the analogy. You decide to start a plumbing business. You call it Floods Are Us. Here's what you do. I have a leak in my house. I call you in. You leave a flood. You're not going to stay in business that long, right? But that's what active portfolio management does. You pay people to do what? To deliver 1.5% less than what you could have done without paying. So why does it persist? Because hope springs eternal. For the same reason you and I walk into a casino saying, I am the guy. How did they build this casino? Where did all that money come from? From other guys, but those are the other guys. I am the guy. I am the guy who's going to beat the casino. So, better or worse, active portfolio management doesn't do that. But let's take all the special one. You found a metric or model that actually works. So markets make mistakes. You found a way to catch those mistakes. So let's give the mistake a name. Let's assume you think Apple is undervalued. Close to home for me. So let's assume that you think Apple's worth $600 per share. And let's say you're right. What's the stock trading at right now? This morning I checked, it's at 458. You go out and you buy 1 million shares of Apple at 458. You have a lot of money. So you found a market mistake. It should really be, let's say it should really be 600. It's trading at 458. Have you made any money yet? No. What's the third assumption you need to actually make money off this investment? The market has to correct its mistakes. We're all believers in market efficiency. The only question is when it happens. Somebody who's a true believer thinks it's already efficient. You and I think markets are inefficient until we take that really big position in the stock, and then we pray for market efficiency. Now, God, please make markets efficient now. right away, because then I can make my money. That third leg is not in your control or my control. You can do everything right, and you can go bankrupt being right? Because you say, how do I make the market come around to what's right? You cannot. You and I don't have the power to control that process, but here's the only consolation price I can offer you. The longer your time horizon, the greater the chance, assuming you were right in the first place, that even though I can't guarantee it, that eventually markets will come around to what you think the value is. I've actually given away the secret ingredient to the intrinsic valuation sauce. You want to use discounted cash flow valuation, say, am I a good candidate? You know the first question I'm going to ask you is, what's your time horizon? If you tell me it's 6 months, my response is, do not waste your time doing discounted cash flow valuation. Not because you can't value assets, but because you're not giving the market enough time to fix its mistakes. I'm going to present some statistics during the course of this class that 90% of the valuations you're going to see out there are relative valuations of pricing. They're not intrinsic valuations, which might strike us as, it's going to be surprising because we're going to spend so much time in intrinsic valuation. You said, this is a good way to value companies. How come more people don't use it? The answer is right in front of you. Think of the time horizon of the average portfolio manager or the average equity research analyst, and you can see why discounted cash flow valuation doesn't work for them. They don't have time for it to work. Danny?
What do you think about people like Bill Ackman who release these presentations?
We'll talk about that. In fact, that's a very good point that Daniel makes, which is if much you heard of Bill Ackman and Carl, what do activist investors do? They find a company, they value the company, and if they think it's cheap, they buy a stake in the company, but they don't sit quietly, right? Then they push, and they push. Notice that these guys are willing to get on CNBC, they talk to, because they want to be the catalyst to cause that third leg. That's an advantage that activist investors have that most other investors don't have. So you could actually argue that if you're an activist investor, that you're a much better candidate for intrinsic valuation than somebody who doesn't have that power to be a catalyst. So let's talk about the advantage of discounted cash flow valuation.
What about the fact that the more time you wait, right, there's an opportunity cost of capital to put into the stuff itself. Like those who
No, but when you wait, you're not waiting for the same price. So basically, when you value it at 600, the 600 doesn't. If you're $600, did everybody get that question? Which is, let's say you have to wait 10 years for Apple to correct itself. The correction will not be to 600, because if your 600 were a fair value today, the expected value 10 years from now will actually be the 600 compounded at your cost of equity. So if you have a 12.5% cost of equity, it'll be like 1,800 or 1,700. So if all you do is adjust back to your zero valuation in year 10, that's not going to help you. So the value itself, if it's done right, will go up over time because of that expected price appreciation that's built in through your discounting. Okay? So now let's talk about the advantages of discounted cash flow valuation. I'm a believer in discounted cash flow valuation, but I'm going to try to give you both sides. Here are the pluses as I see it of discounted cash flow valuation. Because you're doing a valuation that is based on how the company looks, it is going to require you to understand the fundamentals of the business. What business am I in? What's the growth? What's a potential market? What's my market share? What are the margins? If you do a good discounted cash flow valuation, you're going to be valuing a company based on its fund, not based on market perceptions and moods. In fact, there's an old saying that Warren Buffett has, which is, he never buys shares in companies, he buys a piece of a business. And it sounds facetious until you think about it. When I buy Apple, and I think about the shares in the business, and I'm worried about what other people think, what will they do to the price tomorrow. But if I say, look, I'm buying a piece of Apple, and here's what I'm getting. With $450 per share, you know what I'm getting right now? $140 in cash right here, because that's the cash balance of the company. And I'm getting about $40 in earnings from last year, and about $11 in dividends. So if I think about that cash flow stream, the underlying business, I'm doing an intrinsic valuation. Am I concerned that institutional investors are fleeing the stock? Not if I'm buying the business, because I still have a claim on the cash flows. That's easier said than done, because you got to shut out that noise. In fact, I tell people, if you're going to do intrinsic valuation and you have CNBC on your cable listing, You could delete channels entirely from your cable listing, just go through, delete it. The last thing you want is the noise around your head about what's everybody else thinking? Where are they going? Because you're valuing the business rather than... And if you really do intrinsic valuation right, you have to think about competition, what's changing, globalized, everything that should drive the value. And that's a good thing, right? So those are the advantages. The advantages often turn out to also be the disadvantages. So here's the first disadvantage. Because you're valuing the business standing alone, you're not bringing in market perceptions and moods, you could potentially find everything to be cheap or everything to be expensive because you're not scaling around anything. And if your job requires you to find at least some stuff cheap and some stuff expensive, you're in big trouble. I'll give you an example. Let's say you're an equity mutual fund manager. You decide to use discounted cash flow valuation. You value stock after stock after stock after stock, and they all come out as expensive. So what's the logical thing for you to do? It's not buy any shares, right? Sit on cash. You're not going to stay an equity mutual fund manager for very long because your job is to invest in equities. So if your mission is go out and invest in stock, it might turn out that this might be right for you. It is also true that discounted cash flow valuation requires more explicit inputs. You're saying, what do you mean explicit? You actually have to list the inputs. Cash flows and growth. It's a lot more work in terms of what you have to assume, what you have to list. And if you discounted cash flow valuation, but you do it sloppily, you can pretty much get any number you want. We'll talk about why that happens and why it should not happen in a good discounted cash flow valuation. Badly done valuation, it can happen. Yeah. So discounted cash flow valuation is not for everybody. It requires that long horizon, but it also has these pieces to it that make people uncomfortable. So when does discounted cash flow valuation work best? Obvious. To do discounted cash flow valuation, you better be valuing an asset with cash flows. As opposed to what? You can't value a collectible or a Picasso with a discounted cash flow model. There are no cash flows. You cannot value gold with a discounted cash flow model. There are no cash flows. So what do I do with those? Well, there are other valuation approaches you might use, but discounted cash flow valuation is designed for assets that have cash flows. They don't have to be positive right away. They could be negative now and positive in the future. They're best suited for investors with long time horizons. We talked about why. And they're better suited, and this was they're better suited for investors who can catalysts. As investors have, they're able to make that market price adjust. They're able to influence the closing of the price to the value. So as I go through the approaches, think about you as an investor. Also think about if you already have a job lined up, think about what you're going to be doing because already you're going to start to see the pieces play in as to whether you should be using discounted cash flow valuation 6 or 9 months from now or whether something else is going to work better for you. Any questions on the kind of big picture of discounted cash flow valuation? Let's talk about relative valuation. Relative valuation, you value an asset based on how similar assets are priced out there, right? So in relative valuation, you kind of give up on the notion of intrinsic value. So I don't know what the intrinsic value is. I'm going to value an asset based on how other assets are priced out there. And I talked about the example of the realtor showing you houses. She's not valuing your house, she's pricing your house. And if you break a relative value down, here's what you're going to see. You're either going to find an asset just like yours, identical to yours. See, no chance of doing that. Let's say you're looking for a seat for a Knicks game in section 310. I guarantee if you go to StubHub, you're going to find 2 seats right around the seat you were looking for. You can look so that's almost perfect relative valuation. You're finding another asset that looks like yours. You're pricing. With stocks, it's almost going to be impossible to do that. So you're going to find similar assets or similar companies. Second, you can't compare prices across stocks. Why not? If I just look at prices, what's the most expensive stock in the U.S.? Berkshire Hathaway, because it trades at $127,000. And the cheapest stock, of course, is some penny stock. But that's absurd. The penny stock might actually be overvalued, and Berkshire Hathaway might actually be a bargain, because the price is kind of an arbitrary number. Arbitrary because if I double the number of shares, the price is going to drop by roughly half. So you divide the something, price by earnings, price by value. A multiple is just a standardized price. You find a bunch of companies, which you call similar, standardize the price, and then you try to control for differences across those assets. That's the essence of relative valuation. In relative valuation, do you see that make mistakes? Yes, but in a different way than in intrinsic valuation. Intrinsic valuation, markets make mistakes and they correct them over time. They can make mistakes across the board. In relative valuation, you're assuming that markets are right on average. You see why you're making that assumption? Because where are you getting the prices? By looking at other stocks that are trading right now and looking at what they're so you're assuming that markets are right on average, but they're wrong in individual stocks. So the mistake here has to be corrected in the cross-section. It's not across time, but it's in the cross-section. And I think that there's a better chance that a mistake like this is going to be corrected quickly rather than, and here's why. Let's say you have a steel company trading at 5 times earnings in a sector where everything else trades at 15 times earnings. It sticks out like a sore thumb, right? Unlike an intrinsic valuation where it's all in your gut and on the spreadsheet, relative valuation, when you see mistakes, are much more likely to jump out at people. People screening find the stock. So what I'm trying to say is if you have a short time horizon and you want corrections to happen quickly, you have a better shot of doing that with relative valuation than with intrinsic valuation. So here are the advantages of relative valuation, and you're going to see the flip side of discounted cash flow valuation. So the biggest advantage of discounted cash flow valuation is it does market moods and perceptions. You know what the biggest advantage of relative valuation is? It does reflect market moods and perceptions. So how can it be an advantage and a disadvantage? If your job is to price things, you're an M&A banker, you're an IPO bank, essentially you're pricing things for transactions today. You want to get something that will cause the transaction to happen right now. Your job is pricing, not valuation. That's why I'm not too harsh about IPO prices and how they might not reflect intrinsic value. I know your job requires you to price this to sell today. It's not to come up with intrinsic value. So all social media companies are overvalued. It's not your job to go to Facebook and say, you know what, your companies are all overvalued. You shouldn't be going public at all. It's unfair. Your job is to price the stock based on what you can get for it, and relative valuation delivers that. And if you're judged on a relative basis, you know what I mean by that? If you're a mutual fund manager, let's say you're a growth fund, you know how you get judged, right? Morningstar ranks your performance against other growth fund managers, not against an absolute standard. Our job is to find, is to do transactions, or you get judged on a relative basis. Relative valuation actually is much more closely designed to what you do than intrinsic valuation is. So when I look at the 90% of the valuations being relative valuations, it doesn't surprise me because I know that most people are under different pressures than somebody doing intrinsic valuation. Relative valuation, when you look at inputs to relative valuation, one of the arguments used for relative valuation that by analysts, when they ask them, why do you use multiples, is I don't have to make as many assumptions as you do in discounted cash flow valuation. Is that true? Technically, yes, right? Because you have a lot more inputs in discounted cash flow valuation than relative valuation. The reason I said technically is even though you don't have to make as many explicit assumptions, you're making exactly the same assumptions in relative valuation. It's just the assumptions are implicit. You don't even realize you're making them. Let me explain. When you tell me that you're pricing a stock 15 times earnings because other companies in the sector are trading at 15 times earnings, you're making implicit assumptions about cash flow, growth, and risk about this company. You're just not putting it on paper. And that can become relative valuation because if you don't know what you're assuming, how the heck can you decide whether you're making reasonable assumptions or not? I think it's the biggest weakness because in relative valuation, I'm not telling you whether something is cheap or expensive. I'm just telling you whether something is cheap or expensive relative to what everything else out there is trading at. So I could tell you something is cheap, but all I'm telling you is the least overvalued of these 15 companies that I follow. That's the thing that worries me about equity research. It's not even the bias, but your mission as an equity research analyst, if you're following those 15 companies, is to look across the 15 companies and tell me which ones are buys and which ones are sells, right? It's to make a relative judgment. If I'm an intrinsic value investor, I have a really long time horizon. I don't have to buy a steel company or a chemical company. What you call a buy might not be a buy for me because you're making a relative valuation judgment. I might be much more concerned about intrinsic valuation. So keep that in mind. And the final point is remember, when you use multiples and comparables, you're actually a bigger believer in market efficiency than I am in intrinsic valuation, because you're making the assumption that markets are right on average. So relative valuation will work best. It works best if you have an asset that has lots of similar assets out there. Those assets have to be traded because you have to have prices. And you have to have some common variable to which you can scale the prices. So with stocks, it shows up as price earnings, price to book. With real estate, it might show up as price per square foot. But whatever the asset is, you have to think about scaling the price so that you can compare across assets. And it works best for investors who have shorter time horizons, because you need to get that correction quicker. And here's the other thing. In relative valuation, what do you come up with? You come up with stocks that are over or undervalued relative to each other, right? If you're a traditional mutual fund manager, you're restricted to playing on only one side of that fence, which is you buy the undervalued, but since you can't short stocks, you're kind of stuck with that. If you're a hedge fund, you're essentially both sides of the fence. You buy the valued, you sell short on the overvalued. You can make money from both sides. So if you're an investor who can both go long and be short, you're a much better candidate for relative valuation than you're an investor who doesn't have that capacity. Any questions on relative valuation? We are going to take a detour in the second section of this class into what I call asset-based valuation. What's asset-based valuation? Rather than value a whole business, you go down, I call it balance sheet valuation. You go asset by asset by asset, valuing each asset separately. So why would I want to do it? Because it might be your job. We talked about accounting valuation. In accounting, this is fair value accounting. It's not to give me a fair value for the entire company, but to fair value each asset. And in the process, you're going to run into some very serious holes in a balance sheet. Assets that should be there that are not there. So for Coca-Cola, what's the missing piece that you'll have to bring in? You're doing an asset-based valuation. You can take their physical assets, you can do the working capital, but then their biggest asset is brand name. So that's a challenge that accountants now face with fair value accounting, is you're doing an asset-based valuation. All those missing assets now have to show up on the balance sheet. So that might be why you do asset-based valuation. It could also be because you're interested in liquidating this company. You know why you might want to do asset-based valuation then? Because right after you liquidate the company, you're going to sell off each asset separately. So what would I get? But as investors, there's a very interesting use for asset-based valuation. You have a multi-business company. You take a lot of companies. You can think about a GE, but let me take United Technologies. So 6 different businesses. One of the questions you always face is the sum of these pieces worth about what you get for the whole, or is it worth more, is it worth less? The sum of the parts valuation. You might do it as an investor because if a company is trading then less than the sum of its parts, you can say this stock is underpriced. Or you might do it as an activist, because what do you plan to do then as a follower? If you think a company is trading at less than the value of its parts, you could acquire the company, break it up, and you make your money on the breakup value. So asset-based valuation might not be for everyone, but you can see it can have uses in lots of different contexts. But the reason I'm not going to treat it as a valuation approach is if you think about how I'm going to value the assets individually. I can value them based on cash flows, which is intrinsic valuation, or I can value them based on what similar assets are priced at, which is relative valuation. To me, it's not a valuation approach as much as a valuation application. So we'll come back and talk about asset-based. But if you get intrinsic valuation, relative valuation, you should be able to do asset-based valuation. It tends to work best if the assets are separable and not tied to each other. So if you gave me a company with 5 real estate properties, works easy. If you gave me Disney, much messier. You see why? Because separating theme parks from movies is a pretty fuzzy line, right? Because the movies feed into the theme park. So the more the assets get interlinked, the more difficult it will be to do asset-based valuation. But we'll try. So here's a question I'm going to ask you in this session, and I'll come back and ask you the same question in the very last class. So we've described intrinsic valuation, we've described relative valuation, we've described what you need to make it work. There's no right answer here. Think about yourself as an investor, and based on your time horizon, what you think about markets, how you think they work, make a choice. You don't have to tell me. Make your choice. Let's come back to this question in the 15th week. Let's see if the experience of valuing a company changes that choice. Any questions at all about intrinsic or relative valuation? final approach to valuation is contingent claim or option pricing valuation. Let's see what makes an option an option. Here are the three things I would look for to make an option, to categorize something as an option. First, options are derivative assets. What does that mean? They're leeches. They derive the value from, they can't live on their own. There's got to be an underlying asset. So when you say option, my first question is, what's the underlying asset? You say, I don't know what the underlying asset is. I'm not sure there's an option here. So first, you need an underlying asset. Second, you need a contingent payoff. Something has to happen for you to get the payoff. So in a conventional option, the stock price has to rise above the strike price, but you need to tell me what that contingency is. And third, options have limited life. There's an underlying asset, there's a contingent payoff, limited life. In fact, the best way to think about options is to think in terms of payoff diagrams, right? Payoff diagrams, that's how people get introduced to options. And what makes option payoff diagrams unique is what happens around the strike price, right? And what happens around the strike price? If you have a call option, if the stock price drops below the strike price, you're limited in your losses to what you paid for the option. If you have a put option, the stock price exceeds the strike price, you're limited in your, the key is that limited losses. It changes how we think about risk in options. As I said, option pricing models have been around 40 years. Much of this time period, they've been used to value conventional options. What are those? You can have the listed options, the CBOE. You can have warrants. You can have convertible bonds. You can have LEAPs, which are long-term options in companies. Those are all conventional options. I'm not interested in valuing any of those because A, they're pretty straightforward, and B, there's another class for doing it. My interest in option pricing is more exotic. Here are the places that I'm going to go to the option pricing model. You buy equity in a deeply troubled company. You say, what's a deeply troubled company? It's a company losing money. You expect it to keep losing money. It has a lot of debt. You say, why would I buy a stock in a basket case like that? You buy it for the same reasons you buy deep out of the money options. Why do you buy deep out of the money options if you do? You buy it on a hope and a prayer, right? You hope that something good will happen. Then you pray that something good will happen. Most of the time, nothing good happens. But when something good does happen, that 25 cents can become $3 or $4. You essentially buy deep out of the money options knowing that you will lose most of the time. But when you do make money, you could make 300, 400, 800%. Same reason you buy equity in a deeply troubled company. I'm going to argue that when you buy an oil company, especially one like Petrobras with a lot of undeveloped reserves, you're getting an option. Option in what sense? Petrobras has a lot of undeveloped reserves. It can choose to develop those reserves. It can choose not to. So what is that contingent on? Remember, it has to be a contingent payoff. So what's going to drive whether Petrobras develops these reserves or not? What happens to oil prices, right? If oil prices go to 150, they're going to develop a lot of the reserves. They've dropped to 60. They might not. It's an option. If you buy stock in a young biotechnology company, patent working its way through the pipeline, you're buying an option. And if you're buying a small consumer product company with an exclusive license in a big market, let's say China or India, you're buying an option. An option to do what? If this company ever could figure out how to kind of exploit the rest of the market, you're willing to pay much more than the discounted cash flow valuation because you're getting an option. I'm a skeptic when this is what's called real options in finance. I'm a skeptic when it comes to real options because as I see them, they're used all over the place, often in the wrong places. But I think used correctly, they can allow you to value assets you otherwise would give up on. And some of you are going to see exactly what I mean. You're going to pick a company, you're going to try a discounted cash flow value. You know what you're going to find? You're going to find that the value of your operating assets is less than the value of your debt. The value of your equity is actually negative. You're going to come to me and say, I'm in trouble. And I'm going to say, don't worry. Then we're going to get to relative valuation. You're going to try multiples in your company. But what multiple are you going to use? So all your earnings are negative. Your book value might be negative. Your EBITDA might be negative. You're going to come back and say, I'm in trouble. And say, don't worry. And here's why I'm going to say don't worry, because when you get to the option pricing model, you may be able to value those companies. So there are companies out there where traditional models will break down, where option pricing models are going to essentially give you a way of valuing these companies. Exceptional companies, but it can be the case. The other reason understanding real options is useful is even if you never put real options down in terms of numbers, they change the way you think about risk. And here's why. In discounted cash flow valuation, as an increased risk, what happens to value? Don't think too long. Higher risk, higher discount rate, lower value, right? In relative valuation, I'm comparing a risky company to a safe company, higher risk, lower multiple. But when I call something an option and I increase risk, what happens to the value of that asset? Goes up. Risk is your ally with options. And the reason is very simple. When you take risk in an investment, what type of risk are you worried about? Downside risk or upside risk? Have you ever heard somebody complain there's too much upside risk in this investment? I made 850%. It's that downside risk that worries us, right? And what is it about options that leads you to worry less? Remember that it capped the losses? So whenever you classify something as an option, risk flips. And that's a very useful thing to know, is when risk has gone from being your enemy to your ally. And that's why I like real options, because sometimes I have to think of that shift. The disadvantage of option pricing? Traditional option pricing models make some very stringent assumptions about constant variance over the life of the option, the kind of features you need to use, which are tough to meet with real options models. The inputs of the model are far more difficult with real options than they are with conventional options. But here's one other thing to worry about. When people first start using real options, what makes them neat is they allow you to add premiums to the value of your company. And if you're not careful, people get carried away. They double count. They double count by counting something in the cash flows and then counting it as an option. So that young biotechnology company with this great product working its way through the pipeline, they'll put in a high growth rate and come up with a high value, and then proceed to add to that the value of that patent as an option. You can't do that. So you've got to avoid the double counting, and that requires some work, understanding when to stop and what to do in terms of your base value. Option pricing valuation models are not replacements for discounted cash flow models. They're augmentations of discounted cash flow models. What I'm trying to say is, if you decide to use real options, you first have to do a discounted cash flow valuation. After you've done the discounted cash flow valuation, the option pricing model allows you to add a premium on top of the discounted cash flow value. So look at the landscape. Don't make choices yet. As I said, keep your mind as open as you can. And I actually think we've made it an either-or proposition, and it shouldn't be. So you're often asked, are you an intrinsic value person or a relative value person? To which my answer is, I'm both. Why do I have to pay? Why do I have to value a stock just with an intrinsic valuation model? Why can't I also value with a relative valuation model? And if there's an option pricing model, why not with an option pricing model as well? I want a stock that's cheap on an intrinsic value basis, cheap on a relative valuation basis, cheap on an option, because then I have three things working for me. So don't make this an either-or proposition. So even if you're a true believer in intrinsic value, understand relative valuation and use it. Even if you're a true believer in relative valuation, think about using intrinsic value in what you do. So let's put this session to rest, or this section to rest, and start on the first packet. So do you guys, the corporate finance people, have trouble printing off the first packet? Were you okay with it? Are you had trouble too? Okay. Is it just people trying to print in your anywhere you're having trouble? I'm sorry? What is what copy set? Oh, I don't even know what it is. That's a place I think everybody had trouble. Maybe the printers were getting jammed. I had 400 corporate finance people trying to print 300 pages each, so maybe that caused a little bit of a log jam. So, I'm sorry? And you had trouble with all of them? So what's happening? It's not downloading to your computer. It's not printing off your computer. So the printing problem is, okay, let me work on that. Let me see if I can flatten the pages. So for today, though, if you don't have it, don't worry. We'll figure something out. Right? So let's talk about intrinsic valuation. So as I said, intrinsic valuation, you value an asset based on its specific characteristics, its cash flows, its growth, its risk. Discounted cash flow valuation is one way to estimate intrinsic value, but it's not the only way. So let's take apart discounted cash flow valuation. What do you try to do in discounted cash flow valuation? You try to take the cash flows and adjust them for risk and come up with the present value, right? There are two ways you can do discounted cash flow valuation. The first, you take the expected cash flows on an asset across all the possible scenarios, good, bad, they're all built in, and you discount those expected cash flows at a risk-adjusted discount rate. That's the way you normally see discounted cash flow valuation. There's a second way you can do discounted cash flow valuation, which is you can take the expected cash flows and replace them with what are called certainty equivalents. In other words, the question you're asking is, if my expected cash flow is $100 and it's risky, how much of a certain cash flow would I take as a replacement? So let me ask you the generic question. If you're getting $100 in risky cash flows, and I offered you a certain cash flow as a replacement, will that number be lower than 100 or higher than 100? Lower than 100. In fact, if you told me exactly 100, then you're telling me that you're risk neutral, in which case discounted cash flow valuation becomes very simple. But when you say it's less than 100, you're telling me how risk averse you are. That's called a certainty equivalent. If your cash flows are certainty equivalent cash flows, then you can discount them at the risk-free rate. You almost never see the second approach done purely, but you see people mixing these two approaches all the time. Let me give you a couple of examples. You probably heard the story that Warren Buffett uses the risk-free rate as his discount rate. It's a widely touted story. Warren Buffett doesn't care about risk. He uses the risk-free rate. And this has made a story about how the kappa beta is a terrible way to think about intrinsic value because Warren Buffett doesn't adjust for risk. It's absurd to say that. Warren Buffett values companies, right? But when he counts cash flows, he counts only the portion of the earnings that he views as earnings that are reliable. He doesn't quite put a word on how he comes up with reliable, but if it's speculative, and we'll leave that unspecified, it doesn't get counted in when he values the company. So what's he doing in a kind of intuitive way? He's coming up with certainty equivalent cash flows and using a risk-free rate as his discount rate. Here's what gets analysts into trouble. They often get cash flows in a risky company, and then because it's a risky company, they decide to do some haircuts. It's a risky company, so I'll knock off 5, 10%. Do you see the danger of doing this? Once you start to haircut the cash flows and you adjust the discount rate, you're going to end up double counting risk. So when you sit down with a discounted cash flow model, be very clear about where you're going. If you go the conventional route, your cash flows are expected cash flows. Your cash flows are not risk adjusted. People think that if they bring in bad scenarios into cash flows, they're risk adjusting the cash flows. That's not true. And I'll give you a very simple example to bring this home. Let's assume you're thinking about investing in Venezuela. It's a business that's guaranteed. You're going to make $100 guaranteed in 1 year. But there's one catch. There's a 10% chance that your business will get nationalized and you're going to get nothing. So $100 in 1 year, guaranteed, but that's the 90% of the time it's your business. 10% it's going to be. What's the expected cash flow in a year? $90, right? Let me give you a second alternative. I have an investment in, let's say, Germany with a $90 guaranteed cash flow. There's no problem. The expected cash flow in both cases is $90, right? But which cash flow would you pay more for? The German cash flow. And what I'm trying to say is, you see people say, well, I risk adjusted the cash flows. Ask them what they mean, because most of the time, you know what they mean? I brought in the bad scenarios and I attached a probability to it. I got an hey, that's what you're always supposed to do. You haven't risk adjusted the cash flows unless you replace that expected cash flow with a certainty equivalent, and that's a messy thing to do, or you've adjusted the discount rate. So be clear about what risk adjustment is, because there's a lot of misconceptions about what risk adjustment turns out to be. So those are the two equations. You can either take expected cash flows and discount them at a risk-adjusted rate, or you can take a certainty equivalent and discount them at a risk-free rate. Two very basic propositions flow directly from those equations. Here's the first one. For an asset to have value, its cash flows have to be positive at some point in time. I know it's stating the obvious, but might as well state the obvious. Here's another set of emails I get, thank God not as often as the valued cash email. I'm valuing a money-losing company. I expect it to keep losing money forever. What valuation model will work best in attaching a value to the company? Which you feel like slapping the person around the face and saying, wake up. You have a money-losing company, you expect to lose money forever. Why are you paying for this company? They should be paying you. The follow-up to that, though, is you have an asset that has negative cash flows up front. And some do, right? Then it has to have disproportionately large positive cash flows in the future to make up for the negative cash flows up front. What kind of businesses have negative cash flows up front in the year 1, year 2, year 3? Young startups, high growth companies. And why are the cash flows negative? They might be losing money, but even if they're making money, what's happening that's making their cash flows negative? They're investing huge amounts. So when you see me valuing young growth companies, don't be surprised to see big negative cash flows up front. It freaks people out. So, but my cash flows are negative. It's okay, as long as you get big positive cash flows down the road to make up for those negative cash flows up front. So again, very basic propositions, might as well set them on the table. Now I'm going to go back to a vehicle that I use in the corporate finance class, but I think it's a useful way to think about how to do valuation. It's my financial balance sheet. If you remember my financial balance sheet, it's not like an accounting balance sheet. There are only two items on the asset side. Assets in place, investments you've already made as a company, and growth assets. And on the other side of the balance sheet, you have debt and equity. The reason I like this, again, is here are the two ways you can approach valuation. You can value just the equity in the business, or you can value the entire business. Sounds like a mysterious split, right? If you decide to value equity in the business, you wear blinders. Here's what you're going to be focused on. You're going to be focused on the cash flows that equity investors get, which is cash flows left over after you made interest payments, principal payments, after debt. And you're going to be discounting those cash flows back at a rate of return that equity investors demand for investing in the equity, which of course is the cost of equity. Cash flows to equity discounted to the cost of equity gives me a value of equity in a business. If this is a publicly traded company and I buy equity in it, what's the only cash flow that I actually get to see that comes directly from the company? The dividend, right? The dividend discount model is a special case of an equity valuation model. It's the oldest discounted cash flow model out there. It's an equity valuation model. You're focusing on cash flows to equity, discounting back at the cost of equity. Saying, well, how else would I value? You could actually value the entire business. And here's the way to think about it. There are two players in this game, right? Equity investors who get cash flows to equity, and there are lenders who, do they get cash flows too from the business? Or what form do their cash flows take? Interest and principal payments. The collective cash flow you get is called the cash flow to the firm or the business. If that is the cash flow I'm discounting, the collective cash flow, the discount rate has to be a weighted average of what the equity investors want, which is the cost of equity, and what the lenders want, which is the cost of debt. That in corporate finance, of course, is the cost of capital. Cash flows to business discounted to the cost of capital gives me the value of the entire business. And once I value the entire business, can I get back to the value of equity? What do I need to do? All I need to do is subtract out the debt and back to the value of equity. I'm sure if you've done valuation, you've done one approach or two or probably both. So let me ask you a question. You valued a business. You're trying to decide what to subtract out. Remember you said subtract debt. What type of debt to subtract out to get to value of equity? Let me give you some choices and you tell me which one of these you would net out to get to the value of equity. So you value the business, you're trying to get to value of equity. You could subtract out the value of long-term debt. You can subtract out the value of all debt. You can subtract out the value of any debt that was included in your cost of capital calculation. Or you can subtract out the value of all liabilities, which would include accounts payable, supplier credit. You're basically taking anything that's not equity in the balance sheet. Long-term debt, total debt, whatever you call debt, when you did cost of capital, which might include other things or exclude other things, or all liabilities. What do you think the right answer is? I've seen all four done. Okay. As I said, discounted, people call things discounted cash flow valuations. There should be a licensing system for this. Okay? Because people do strange things. You know the right answers? When you computed the cost of capital, you already set your marker. So if you said, I'm going to include total debt and I'm going to include lease commitments and debt in my cost of capital, guess what? You can't change your mind at this stage in the process. If you decided to use only long-term debt when you did cost of capital, then subtract out only long-term debt. Your cash flows have to be determined based. Everything has to be driven by the choices you made when you did that cost of capital calculation. That's why when in a couple of sessions we talk about cost of capital, I'll talk about what I like to include in debt and cost of capital. But it doesn't have to be what you include. And if you decide to include something different, then make sure when you get to this stage you're subtracting out debt. I'll give you an example. I don't include underfunded pension obligations as debt when I do cost of capital. Now I'll give you my rationale. But let's say you decide to do it because you work in Germany, and there it's more like debt than it is in the US. That's fine. But when you get to this stage in the process, then make sure you subtract out those underfunded pension obligations as well to get to the value of equity. So there are two ways I can value equity, right? One is directly, by taking cash flows to equity and discounting the cost of equity. The second is indirectly, by taking the cash flow to the firm, discounting the cost of capital, subtracting out debt. Should I get the same value for equity both ways? Ask you a different question. Would you like to get the same number for both? I would, because can you imagine putting out an equity research report? I did 2 valuations of the company. My equity valuation of the company looks like a screaming buy. My firm valuation looks like a terrible sell. This might cover you no matter what happens, but it's not a great way to get a reputation as somebody who is talking out of one side of his mouth. But the key, though, is to do it right. And it's one of the most difficult tasks in valuation is to actually figure out how to get the 2 values to converge. Remember I talked about weekly challenges? Okay? Your first weekly challenge will come to you right after class today. And it's a very simple challenge. It's about a business that I'm going to describe to you. Okay? Because if you do it right, you should get the same value, but it's not as simple. In fact, in the example that I'm going to end this session with, I had the cash flows to equity and cash flows to firm. I gave you a cost of equity and the ingredients for the cost of capital. There are 2 ways I can value this business. One is I can take the cash flow to equity, discount the cost of equity, and I get a value of 1,073. Or I can take cash flow to the firm, which is the pre-debt cash flow, discount back at the cost of capital, and I get a value of 1,873. Net out the debt, I get the same. This seems easy, right? Value of equity converges. But that's because I cheated. I cheated in this example by putting in implicit assumptions that made the values converge. This week's weekly challenge is about, I'm going to give you a company where initially when you value the equity, you're going to get different answers. And I'm going to ask you why. What is it you need for the 2 numbers to converge? Think about it. I mean, it's an interesting challenge, but more important, it'll lead you to think about what the implicit assumptions are when you use firm valuation versus equity valuation. So I'll put it out there. You can submit it on Lore. On Sunday evening, you'll get my solution. So I won't respond to you when you send your answer of the week, but you can look up the solution and check to see whether our answers converge. Okay, see you Monday.